The more founders in climate tech that I talk to, the more pitches that I see, the more it stands out to me that although climate tech and general entrepreneurship are different, climate tech founders should still be thinking about pitching themselves in very similar ways. Are funds the same way? Should venture funds be thinking of themselves as venture funds in climate tech funds, or some other hybrid in between?
Was the number of investments intentional? Yes, absolutely it was. We came into this really thinking about the stage and the size of investment that we will do in our initial checks, how many of those companies, can be successful. If you look at the top quartile funds, you tend to see that they tend to have like a 50 to 60% graduation rate from seed to Series A. And those are the best funds in the market. So even their companies, 50% of them don't raise a next round after a seed round. If you are lucky enough to be a homeowner, then decarbonizing your home is actually the single most impactful thing that you can do as an individual. It's more impactful than going plastic free, more impactful than becoming a vegetarian. It's more impactful than driving an EV. It's even more impactful than giving up flying altogether. So in Europe was actually many countries within Europe were kind of quite far ahead in terms of their home decarbonization and rollout of things like smart meters. So you see, for example, in the Nordics, there's a very high penetration of smart meters, high penetration of EVs, high penetration of heat pumps in some cases as well. Whereas the UK has always been, I would say, pretty far behind in this aspect. They surveyed tens of thousands of homeowners. Almost 90% of them found the government should offer more green incentives, and over 50% said they would make green home upgrades if they had some financial support. So some of the big problem is around the availability of financing.
Welcome back to the Clean Techies podcast, the number one podcast for climate tech entrepreneurs. On this episode, I'm joined by Rahul Parekh, partner at 2150, which is a venture capital fund based in the UK focusing on urban environments. So you can understand why I was really, really excited for this episode. It started off as a general conversation about climate tech, about their investing thesis, but got into almost this VC fundamental extraordinaire, and I really felt his background in general venture speaking out to me when he was explaining how they invest in climate tech and how they've structured their fund for success. This is more of a nuanced topic. The way you structure your fund is not something that immediately jumps out, but for founders, for people looking to get into the venture space, Rahul gave us some really cool insights into how he thinks about 2150's fund and how they've been able to successfully raise another one. This was a lot of fun, and it was definitely worth spending my holiday evening on. Thank you all so much for listening to this episode. Let us know what you think in the comments, and enjoy the episode. But before I let you go, please, if you listen on Spotify, Apple, whatever platform you listen on, take a second right now to leave a review. I'll even give you a couple seconds right now. Cool. Done? And if you aren't already, go to cleantechies.substack.com and subscribe. All right, here's Rahul. All right, Rahul, welcome to the show. How are you?
Thank you. I'm great. Thank you for having me. Very happy to be here. Excited about the conversation.
Yeah, thank you for coming on. You are very much giving us your evening time for this, so I really appreciate it,
Very
where
much.
you are in the world. Where are we finding you?
I'm based in London.
Very
It's
cool.
a very sunny day, bank holiday here today. It's been a great day actually.
Rahul's very graciously decided to take his holiday time and give it to our podcast, so we'll 100% make it worth your while. Please don't leave the audience in suspense. Who are you?
So I'm Rahul. I'm at a partner at a fund called 2150. We're a venture capital fund. We are actually a fund that's designed. Well, let me give you some background around the name. So we're designed to do our very best to make the world of 2150 not just a reality uh, for us, but a world that we actually want our grandchildren to live in. I'm a recovering investment banker and derivatives trader. I worked at Goldman Sachs for many years. I call myself a grateful venture capitalist because I'm grateful for this incredible opportunity that we have ahead of us, but also to make a difference in the world and provide outsized returns to those that are willing to take some risks today. And I'd love to tell you about 2150 as well. So we're a global fund. We invest in early stage companies, and we focus specifically on sustainability within urban environments, so within cities.
Definitely. And I think that You simplified a lot of things that we're definitely going to break down in this episode. One of the coolest things about what you do is the overall urban ecosystem that you participate in, and how 2150 is doing a lot of really cool, groundbreaking work that gives you great insight into topics related to decarbonizing urban environments. And one of those that's very hot right now is home decarbonization. So I wanted to ask you, what's your hot take on home decarb?
Yeah, so this is a topic that I agree is really hot right now. We spent a lot of time working on this. And the reason it's so exciting is that decarbonizing residential homes account for 20 to 30% of global emissions, mainly from operating emissions, so the energy usage in those homes. And it's worth bearing in mind that if you think about the pace of urbanization, that we're going from 50 to 70% of people living in cities over the next 30 years. So we're going to have 2 billion new homes built over that period. So if you imagine thinking about home decarbonization as a sector, imagine putting in 2 billion new traditional gas boilers and locking in carbon intensive assets for the next 20 years. We absolutely want to avoid that happening. So that's one of the biggest problems to solve. And then decarbonizing our existing housing stock is also an incredibly important problem to solve. And the reason why it's so exciting is that if you are lucky enough to be a homeowner, then decarbonizing your home is actually the single most impactful thing that you can do as an individual. It's more impactful than going plastic free, more impactful than becoming a vegetarian. It's more impactful than driving an EV. It's even more impactful than giving up flying altogether. So it's such an important thing to be able to do if you're a homeowner. And it's also significantly cheaper for people to do in the long run, at a time when obviously household energy bills are at the highs. So the biggest question we ask ourselves as kind of venture capitalists in this space, and thinking about how technology could help to accelerate the decarbonization of homes, how to make this problem simpler to solve. The biggest question we're asking ourselves is, why aren't people decarbonizing their homes quicker if there are so many obvious reasons to do so? And the answer is, it's not because they don't need to. So, like, if we think about us in the UK here, we've got 29 million homes in the UK. The housing stock in the UK is one of the oldest, it's the worst insulated in all of Europe. And actually, only 15% of the housing stock here in the UK was built since 1990. So it's very old housing stock. And it's also not because people don't want to. Generally, they don't have enough knowledge and enough support, and it's predominantly a financial problem. So that's why I think it's exciting for us, because that's where venture capital can come in, and we can help to the founders that are creating fantastic businesses to help solve some of these problems.
Home decarbonization is a place where a lot of the policy is incentive driven,
Yes.
especially in where I'm speaking from and where I have the most coverage in the United States. A lot of the times it's putting the burden on the homeowner to figure out how to do the implementation and then giving them incentives for doing that. In your opinion, do government incentives generally work, or is there some evolution that's needed there?
Yeah, I think that's a great question. So there's actually a decent dichotomy between the US and the UK, for example, in this aspect, which is that in the US, we actually see a lot of government incentives coming in to help homeowners decarbonize. So, for example, if you buy a heat pump today in the US, you get significant tax breaks and incentives to do so. Contractors also get big benefits to be able to install them. Similarly, with solar in the US, up until relatively recently, there were very decent laws around net metering, so you could sell back your energy that you generate from solar in your home. If you have excess energy, you could sell it back into the grid for decent pricing. That's gone away because there's just so much solar available now. And actually that's had a quite big negative impact on the solar market in terms of growth in California specifically. But we are seeing in the US like really big government incentives now, particularly around heat pumps, and other things. Whereas if you look at the UK, for example, we don't have that. Actually, government incentives have actually been in some cases taken away from that in the last couple of years. And also some of the targets that were placed initially around when, for example, gas boilers were phased out in new build construction in the UK, those targets have been taken away. That the actual target timing, so when when they're supposed to be phased out by, that's been delayed even further in the UK. So actually, you see a big difference, big dichotomy between the US and the UK. And actually, I think it's one of the reasons why the UK is probably the slowest to deploy heat pumps, the slowest to decarbonize homes. It's probably one of the big problems that needs to be solved in the UK. So actually, we're seeing that in the US that market is really accelerating, and as a result, because those incentives are there, we're seeing a lot more innovative companies trying to move into the US or growing from the US, and actually then a lot more venture capital available there as well to take
I
advantage of those options.
Hey guys, sorry for the interruption. I just need a few seconds because Soma and I have two quick favors to ask. Putting out the show each week takes about 15 to 20 hours between us, so it's a lot of effort, and it would mean the world to us if you would leave a review and mention your favorite episode. Secondly, if you're not already, go over and subscribe to the podcast on Substack. The content is free, but if you like hanging out with us each week, maybe we're even the kind of guys you'd like to buy a coffee for on occasion, consider becoming a paid subscriber. For the cost of one lavender latte a month, you can help us immensely. Thank you for tuning in consistently and helping us to share our guests' stories. Now back to the show.
think it's a fair thing to say that the US is also at this newer, right, than the UK. The US has been relatively slow moving up until now, up until the IRA passing for the most part. So I wonder if there's something we can learn from the journey of how the UK is both gone from endorsing it to scaling it back. From where you sit, is there an evolution that's happening that's causing this to follow maybe somewhat of like a cyclical effect?
I actually think that that's happened in Europe for sure. So in Europe was actually many countries within Europe were kind of quite far ahead in terms of their home decarbonization and rollout of things like smart meters. So you see, for example, in the Nordics, there's a very high penetration of smart meters, high penetration of EVs, high penetration of heat pumps in some cases as well. Whereas the UK has always been, I would say, pretty far behind in this aspect. And I think one of the big problems in the UK is that, and actually there's a great survey done by a company called Nesta in the UK who does a lot of the kind of energy advice. They surveyed tens of thousands of homeowners, and almost 90% of them found the government should offer more green incentives, and over 50% said they would make green home upgrades if they had some financial support. So some of the big problem is around the availability of financing. And in the UK, that's been a big challenge, because in the past there was a decent availability of financing for example, for solar systems, and then there were a lot of big problems around mis-selling of those loans, and so that industry completely changed and scaled back significantly, and then only now is it coming back again. Whereas in the US, we've seen actually the big growth in some of those green financing companies and green financing sectors, and it was only in the last couple of years when the macro environment changed that then started scaling back.
So it's almost like the incentive structure wasn't ready or wasn't meeting the enthusiasm that people were trying to to spur, right? I mean, that sounds a lot like what happened with CleanTech 1.0 and the solar panels and all these clean tech companies. They built up to a certain level, and then it came time to be like, okay, where are these companies going to go? Who's going to grow them? And everyone was like, not me, right? So it kind of seems like in this sense that people are asking, homeowners to make those changes, but when they're like, okay, how can you help me? Like, not me. I don't know. That's kind
Yeah,
of what it sounds like.
actually, it's a big ecosystem thing, right? So there's the financing side, but then if you as a homeowner make a decision to go and then install, let's say, a heat pump, for example, and you get the financing to do it, who do you go and ask to install it, right? You need to go and find an engineer, and actually, there are very few contractors out there compared to gas boiler contractors, right? So yes, there are contracts, particularly in the US. This is growing. In the UK, it's a huge difference. I mean, we're talking like hundreds of thousands of gas engineers versus like single digit thousands of heat pump engineers. So it's a big skills problem. So that's also where the government can come in to provide apprenticeships and upskilling for some of these engineers. So it's more of like, I would say, an ecosystem thing. You're thinking about the hardware solutions, the homeowner, the knowledge building, the finance availability, the government incentives, the skills that are available in the market. So there's a lot of things that need to happen, but that's like, if you think about all those different touch points, that's where tech companies can actually help and solve some of those
Right.
problems and accelerate that process And that's again where venture capital comes in.
That's a great point. And I won't get into this right now. But one of the main things you mentioned, especially in the built environment, is the workforce development availability, the upskilling. That's a huge question, and actually a huge focus of some of the investing that I do is looking at workforce availability and the different dynamics of these marketplaces and figuring out who's going to crack essentially the unsolvable puzzle first. And part of that also has to do with, where legacy industries are and how we're going to mobilize those people across different geographies. So it's not even as simple as here are some people in England, and they'll be able to easily convert to this type of work. Well, those people might all be in the north, right? And so it's no easy task to get them all to move in the south, right? And that's the opposite here. A lot of the drilling companies and technologies actually exist in the south of the US.
Yeah.
However, a lot of the demand and need is in the north. So I just wanted to give that anecdote because geothermal is obviously a big urban problem as well.
Yeah, absolutely. Yeah, totally agree.
The audience has had a taste of a lot of really interesting things and smart things you've had to say, but they're probably wondering where it comes from. So
Sure.
you started your VC career, a very bad segue there. You started your VC career as a recovering IB banker in 2015. And when we actually talked about this before the call, you mentioned that this was when companies were trying to be the Uber of everything.
That's right.
What was that like, and what was it like learning from that time?
Yeah, that was a really exciting time. So I started my venture capital journey in 2015, and it was just about the time when you could pretty much get anything at the touch of a smartphone button. That's what people wanted, right? You could get food on demand, laundry on demand. Everything was happening. Transport obviously had been there for a while. Uber had been around for a few years back then, and so what we started seeing was this kind of big immersion of companies in that space that were combining technology, so ordering platforms on an app with last mile delivery, right? And so we started seeing that kind of wave of new startups doing that across the world, actually. And the interesting thing about kind of starting venture capital in that in that kind of sector was that initially, just like it is in most sectors in venture capital, when things are exciting and hot, you start seeing kind of really big bubbles and valuations that are incredibly high versus the fundamentals that are available for those companies at that point in time. So, for example, companies that had very early stages seeing kind of significant top line growth, so lots of revenue growth, but really struggling with their unit economics, so really struggling with the potential profitability of those businesses, still seeing kind of lots and lots of activity in terms of venture capital and high valuations. And so we started to see over a few years a number of kind of winners emerge, but many companies actually fall away. And because it's actually a really tough one. It's a tough problem to solve when your delivery costs are high and your whole business depends on how much order density you have in a very specific area in order for you to make the delivery economics work. And we've seen it in the US, we've seen it in Europe. Many of those companies have failed to manage that problem as they grow and expand. So often you start in a small location, you start doing lots of orders and deliveries, and you start seeing that actually it's possible in a very specific location, let's say a 1 mile radius or a 1 kilometer radius, it's possible to make this business profitable and grow and scale. And then suddenly you get lots of venture capital cash telling you to then scale up and expand nationally and then internationally, and then suddenly you find that it's incredibly difficult to maintain the same order density in other areas as you expand, because it takes up huge amounts of marketing cost because your brand and your business isn't known there. So you're burning through huge amounts of cash just to try and get the top line growth, but the unit economics never follow. And so in the UK, for example, we had a couple of winners emerge in that space, Deliveroo and Uber Eats in the food space, for example. But most of the companies then didn't manage to succeed. So it's actually a really interesting time to be investing in venture capital and seeing the importance of the fundamentals of unit economics and backing your business have to really work out, even in a massive market with lots of capital available to invest in. And that's kind of where my journey in venture started.
I mean, you come in at a time where there's so much hype
and
It
people
was,
are
yeah.
very inspired. Yeah, right. People are inspired by the Uber, fast growing startup. If they can do it, anyone can do it. What can software enable for us? What can, these unit economics do for us? And then the hype dies. And then you see a bunch of founders fail and you see a lot of mistakes learned, like you just talked about. Climate, knock on wood, it hopefully isn't following that trajectory, but a lot of people do stipulate that there's a decent amount of hype in some of the technology that's being funded. Do you see any resemblances between the VC cycle that you entered and maybe some of this fever dream around, okay, if they can do this, we can do it? Or do you really see that that's sort of an unsubstantiated claim?
Look, I think the tough thing is, and you know this as an early stage investor, VC is sometimes all about hype, right? I mean, especially when you're investing at early stages in companies, you have very little information beyond a belief that the founders can make this work. And this is a great market opportunity. You have very little information beyond that. And you're then offering these companies often millions of dollars at tens of millions of dollars of valuation for very unproven technologies. And that's just the same in the climate space as in AI or in any other space that's seeing a lot of hype at the moment. So I don't think that that's kind of anything realistically different. I think what we need to demonstrate, I think, in the climate space is that it's possible to build big businesses if you're also generating real assets and you're impacting real assets. So, for example, ClimateTech, we talked about this previously, is not just about software, right? And where venture capitalists have historically made money is from backing software businesses that have found business models that could be successful and scale and increase, plow in lots of capital, allow them to increase their marketing spend and build a moat of customers, and then grow some defensibility that way, and then keep growing, and then figure out a way to make their businesses profitable because they have relatively high gross margins as a software business, very high marketing costs, but then at some stage and at some scale, you see the kind of that driving itself because of the brand recognition. That's very different in the climate space. A lot of these technologies and sectors are very nascent. You mentioned geothermal already, right? It's like super nascent sector, and there are many others within climate that are very nascent technologies that we don't know a lot about yet. We're still investing in R&D, but there are huge potential in some of these companies to generate big defensible moats through those technologies and through that R&D spend. So I think one of the things we need to prove out as kind of venture capitalists in the climate space is it's possible to make money also investing in hardware and not just in software. And I think that's one of the big question marks and the big challenges. And I also think that if you think about the need of some of those businesses, they need capital for very different things than traditional venture-backed companies. So they need it to fund, research and pilots and first-of-a-kind factories, and that then requires like a more vertically integrated financing approach. So I think that's becoming, a better understood problem. Like you mentioned already, the IRA. In some of the markets, the government is stepping in; they're providing more grant funding. In others, we're seeing a lot of funds helping to educate other investors, bigger investors that can help these companies. But eventually, we hope that these companies can have huge defensible, competitive moats that can make them more profitable and more defensible than a typical B2B, SaaS company that they might be used to.
All super valid points, especially if we think about like where we are at this moment in time. I think we see this sort of crop of Series B, Series A to Series B founders that were founded maybe about 2-3 years ago, around all of the hype that was 2021. Yes, a lot of that might have led to some, war stories of bad evaluations and unsustainable sort of fundraising conversations. But a big, great output of that is that founders know what about their technology works and doesn't work. And so we have a general sense of, for example, Forterra is one of our previous guests in Net Zero Cement, right? They were one of the only ones to survive some of this net zero concrete hype of maybe two years ago. And so they focus on a process that works and that actually like gives the return that you're aiming to give. So I think that is a very clear parallel that's already started to happen, and I'm sure will continue to over the next couple of years. As we talk about investing, I'd love to use this to talk about 2150 and also understand you have a super special journey within 2150. So first, to set the scene, I'd love to know, what is 2150's investing strategy?
Yeah, sure. So we're a global venture fund. We invest in early stage companies. We're focused on sustainability within the urban environment. So by that, I mean we're backing businesses that are changing the way cities are designed and constructed and powered. And we've already invested in some transformative tech companies before, that we believe that can become not just unicorns, but also gigacorns, we call them, which is a term coined by my partner, Christian Hernandez, a few years ago. And that defines companies that we hope will lower CO2 emissions by 1 billion tons per year, while still becoming commercially successful. And we typically invest between 5 and 15 million as a first check across most of the climate and urban tech sectors. And moving on to our thesis, our main focus is how do we make the urban environment net zero? Cities already consume over 2/3 of the world's energy. They account for more than 70% of global CO2 emissions. I mentioned at the beginning of the conversation that there's this pace of urbanization, right? It's going up. There's many more people moving into cities over the next 10 to 20 years. And so it's clear that if we can't win the war on decarbonization in the built environment, there's no way we can get to net zero globally. So we need huge innovation in cities for this to happen, and that's why we exist effectively.
Investing in cities is obviously a very favorite topic of mine, as you know, and the audience does know.
Yeah.
But what made you specifically choose to invest in cities rather than it being sort of an add-on to a broader thesis?
No, I really love talking about this, because often we always talk about the bad thing, right? So they account for the CO2 emissions, a high percentage of CO2 emissions, and lots of energy usage. But often what we forget is, and what we need to remember, is that cities are actually really good for humanity, and that's why we want to invest in cities. Urban citizens are on average, they're healthier, they're better educated, they live longer, they're more prosperous. And so when we think about the technology that's needed, it's not just kind of about carbon reduction, although that's where we could have the biggest impact in terms of decarbonization in the urban environment, but it's also helping cities become more resilient, more efficient, and more sustainable. And that's why we're super excited about investing in this sector.
I think one of the coolest things about investing in cities is, as you go through your journey, you hear about all of these positive sort of feedback loops where if you invest in newer HVAC infrastructure, you'll improve the air quality. Improving the air quality removes respiratory diseases. That, of course, increases life expectancy, creates better sort of living experiences in cities, and it continues. And so part of working within such a connected ecosystem is the potential to have, impact that's greater than just, reducing emissions for climate change. And I definitely resonate with that. Building off of learning about the way that you invest at 2150, when we talked previously, you'd mentioned that there's sort of a core 80% and maybe what I'll call a flex 20%. Could you talk about that breakdown?
When you talk about the core, 80% thesis, so the businesses that are kind of within our, let's say, our core, our 80% strategy is in our core markets. So in the Europe and US, companies typically at the Series A stage. So in terms of software, they typically have revenue, they're growing, they need capital to scale up. Or in the hardware space, they have technology, they have product, and they're looking to commercialize that product, maybe with a first of a kind factory, or otherwise. And so we can provide capital to be able to do that. That's kind of the core of our business and the majority of the investments we've done. And we do have a pocket of capital where we think we can invest in other types of businesses, maybe outside of the core geographies, or outside of, or maybe earlier stage where we just see some, really fantastic founders, incredibly credible, and they have the potential to build a big business in the space, and they really are doing something transformative. One example of something like that is we made an investment in South America in a company called Vamo, and they're electrifying two-wheelers in Sao Paulo. And although it's not necessarily our kind of core market expertise, we went there and we met them, and we saw this kind of incredibly large market. There's like 5 million motorbikes that were sold last year in Brazil, and less than 0.5% of them were electric. So it's incredible opportunity there. And the guys at Vamo are creating this electric two-wheeler leasing company. We've seen this work in other markets, for example. There's companies in India that are doing this. There's other companies in Europe that are doing this. They're building a battery swapping network targeted at motorcycle couriers in Sao Paulo, and they offer a subscription package, rental of the motorbike, and also battery swaps within the network. And they're growing incredibly fast and doing very well, and it's cost competitive with the ICE motorbike equivalent, and they're building all this infrastructure out. So they're also helping the city also grow, because they're building all of this energy infrastructure to kind of propel the transition to electric vehicles and reduce urban air pollution. So that's really exciting. And then there's another one in Asia. Again, not our core market, but going back to your point about urban air pollution being just as big a problem as decarbonizing urban environments. We made an investment in Asia in a company called Amped Energy, and they're decarbonizing construction sites with emission-free generators for heavy lifting machinery. Because the interesting thing there is that typically cranes require so much energy density when they're operational that the average diesel generator used in construction emits 70% more CO2 per kilowatt hour than a coal-fired power plant. So it's like incredibly polluting. These diesel generators that are portable and powering these cranes, heavy machinery on construction sites. And Amped have created these clean, quiet battery power generators, and they make electric power the primary energy source for construction sites. And they use 80% less CO2 versus diesel generators. So they're really, really exciting, and they've deployed their generators across construction projects in Hong Kong, Singapore, Australia, UK, another really exciting business.
80/20 is like a very popular breakdown. I think Pareto's principle obviously is 80/20, and so that maybe that's where it's from. But how did you come across like 80 and 20 as your breakdown?
No, it wasn't really defined as 80/20. It kind of turned out, to be that way. And
Oh wow, okay.
it was primarily, I think, it happened naturally, right? So we're generally we're seeing lots of deal flow in the US, lots of deal flow in Europe. We're partnering with a lot of early stage funds that do pre-seed and seed stage investments, and they're looking to us as a fund that could potentially lead the next round. So that's where the majority of our capital is going into. But then we see these great opportunities outside of that, and we sometimes can't help ourselves, right? So it just happened to be the case that it's a little bit 80/20. And I think
Nice.
that's the nice thing about venture capital, right? You do have the opportunity to invest in these companies with a really long term horizon. I look back to my old days on the trading floor at Goldman, and that's one of the downsides of that type of business, where you're really investing day to day, or week to week, or month to month. And here, right, we really have the opportunity to invest with a long time horizon, in companies that we really think could be transformative. So it's a pretty exciting thing to do.
Yeah, definitely. And I guess that's part of that's like the nature's rule of things that probably just happened again. It sounds like, so just naturally. Talking a little bit more about fund strategy, we talked about your fund one. It turned out to be a really great fund. Part of the architecture of that fund is that you made about 20 investments.
That's
and
right.
This is kind of like if the number of investments a fund makes is not really as chaotic or random as people might think. Oftentimes there's real modeling and simulation that goes out of it. So I'm curious, especially investing at the early stage, the number of investments is usually pretty important, pretty intentional.
Yeah.
How did you come across 20 investments? And generally speaking, maybe the size that you're investing with, where does that come from?
Yeah. So Fund One was just over $300 million for 2150. And we did a lot of extensive modeling at the beginning, thinking about portfolio modeling, portfolio strategy. And it is true that when you're actually investing, a lot of the modeling itself goes out of the window, because no investment that you see perfectly fits the model, right? So you always have to think about kind of adapting as you go along and as you're investing. And the market changes too. I mean, when we started modeling out our plan for Fund 1 2150, it was in 2020, and then suddenly we started seeing this massive growth in venture capital coming into climate tech in 2021 and the beginning of 2022. And then suddenly we saw the opposite of that happening towards the end of 2022 and 2023, which was a very difficult market for venture capital and climate tech. So, just in this short space of time at the beginning of our fund life, just in our investing period, we saw like two completely different markets. And so you definitely have to adapt, right? And so I think that's, rule number one, that, no investment will fit the model and the market will change. However, going back to your question as kind of, was the number of investments intentional? Yes, absolutely it was. We came into this really thinking about the stage and the size of investment that we will do in our initial checks, how many of those companies can be successful. If you look at all the data, and we did our own modeling on this, but we looked at all the available data sets that are out there. If you look at the top quartile funds, you tend to see that they tend to have like a 50 to 60% graduation rate from seed to Series A. And those are the best funds in the market. So even their companies, 50% of them don't raise a next round after a seed round. So you have to take into account the fact that some of those companies will unfortunately not make it to the next funding round. That might not necessarily be a bad thing. It might be because they didn't need more capital, which would be a great thing. But it might be that they just weren't able to raise more capital and they did need the capital. And so you take into account the conversion rates to the next round. You take into account the valuations that you're expecting in future rounds and round sizes you're expecting, again using historical data. And then you look at what you're targeting in terms of your IRR of your fund, your multiple of the fund, and whether you can meet that with the portfolio you've constructed, knowing that some of those companies won't succeed. And in venture, there's this thing called power law, which I know you know a lot about. But generally, it's the fact that a very few number of your portfolio companies drive the majority of returns. You tend to find only 10 to 20% of your portfolio companies or your portfolio itself drives 80% plus of your returns, which means that generally what tends to happen is venture capital funds, if they're successful, will find that they've picked one or two winners in their portfolio that drives all of their returns, and all of the others don't matter, which means that you're optimizing your portfolio. If you're an early stage investor, you're optimizing your portfolio towards hoping to find, increasing the probability of finding those one or two winners, but also minimizing the probability of losing lots of money on the ones that don't succeed. And so there is an optimal kind of portfolio size, because if you invest in too many companies, you have too many that also fail and not enough driving the performance. And if you invest in too few companies, you have lower probability of finding those outliers or winners. And so generally we found that with all of the analysis that we did, 20 to 30 portfolio companies at the early stage was the right kind of strategy for a Series A fund. We tend to find that seed and pre-seed, it's a bit more than that, and Series B plus, it's a bit less than that.
And that was sort of the sweet spot. That's very cool. And I'm sure the mapping it out must have been pretty cool to see, like this is the amount where you see this kind of like perfect balance between the risk, but also the potential reward, where if one company hits a home run, it still makes a big enough impact based on the amount of equity you have in the company. That's super cool.
And that's where, there's this always this big debate with venture capitalists, like, do entry prices matter, right? So you see some VCs say it doesn't matter, right? Like, you need to get in at the right time, you need to find the right founders, and if those businesses are successful, then eventually they'll be so successful that the price you invested in at the beginning just has no impact, right? Whether you invested in a 20 million pre-money valuation or 100 million pre-money valuation, if it exits for tens of billions, who cares, right? That's one one side of it. The other side of it is that actually, not every company is going to be successful. The majority of companies aren't going to hit that home run and exit at tens of billions. And so even if you have a few companies that do pretty well and exit at, let's say a few hundred million, then entry prices really matter, right? There it really matters whether you invest at 20 million pre or 50 million pre. And if you look at the market today, that's actually a really important question to ask, because if you think about the exit opportunities, right? If you look at exits in the public market, public IPOs were down 70% last year. So the opportunity for IPO as an exit has definitely decreased, particularly in our space. Secondly, if you do IPO, you generally have very little liquidity unless you become a massive business, and then you start seeing liquidity. So as a VC, if you manage to be successful enough to invest in a company that IPOs, it's very hard to get out of that position for a long time, right? And so then you look at acquisitions instead. And the big tech companies are much less active than they were a few years ago, right? Microsoft, Alphabet, Amazon, they're much less active in terms of acquiring companies, and they're building a lot of technology in-house too, right? And so that as an exit route is also less obvious now. And those companies, those big tech companies, Meta, Amazon, Alphabet, Microsoft, they were buying companies for multiple billions, right? And less price sensitive. Whereas now, what are your exit opportunities? Your exit opportunities are more likely to be PE. And private equity are successful, they're sophisticated investors that also want to make a multiple on their investments. So if you exit to a PE, then you're exiting to someone who also wants to make 2 or 3x when they exit. And so they're also very price sensitive. So they're not going to buy your company at multiple billions unless it's really, really worth it fundamentally. So they're probably going to buy your company at, the low digit hundreds of millions, right? And that's where you see suddenly in this market today, entry price really, really matters. Because if you're going to exit at 200 million, 300 million, it really matters where you got in, whether you got in at 20 or 50 or 80.
Definitely. I wish we could talk more about this, especially because I think this is so present to climate tech. And like you said, the current IPO market, the ways that you exit in climate tech, like I think the valuations are just a lot less and the exit values are a lot less. So the internal mechanics of these matter way more, especially for a fund at your size. But speaking of the fund that you're in, one thing I want to make sure we get to before we close out is your own journey within 2150, specifically to, as I understand it, being the climate fintech lead. So I'd love to hear, what your perspective is there. How did you grow that practice, and what was that journey like?
Yeah, I mean, I think that's an interesting question, because the intersection of finance and climate is one that's always excited me. I know climate fintech has become quite a big theme, I think, over the last couple of years. When I first started at 2150 in 2020, it really wasn't a big theme at all. I mean, just a simple example, when I first started, one of the first things I started looking into was carbon accounting, because I saw this big opportunity there where companies were starting to set net zero targets, but really finding it very hard to measure their current carbon emissions, baseline their current carbon emissions. And so, then we started seeing that in some markets, regulation was starting to come in, and there was a lot of talk about regulation coming in that would mandate companies to baseline their carbon emissions. And so then I started seeing it more and more important that actually companies are able to do this. And then eventually, you go back to the old adage, which is like, you can't manage what you can't measure, right? Like we see this in every market. And so measuring your carbon emissions is really important. So we started mapping out carbon accounting companies back in 2020. I would say much before it became, very hyped up, kind of part of climate tech a couple of years later. And at that time, there weren't that many companies doing it within, as a pure software play. We invested in one company called Normative, which was really the category leader at the time, and still is in Europe. Thankfully, they've done incredibly well. They're still one of the category leaders in Europe. But we started to see, and that was kind of the beginning of my journey in this climate fintech space, is that we started to see that actually there is this big intersection there where financial markets and financial institutions can really help drive adoption of some of the climate technologies. And we find that the availability of adequate finance is a benefit, is it kind of is it really a win-win? Because if you're providing finance for deploying climate solutions as a financial institution, you can also claim benefits for that. For example, you can access green financing, right, and cheaper rates of financing. So, for example, if you're a bank that's done lots of lending lending to homeowners, and you have a big mortgage portfolio, well, if you can help to decarbonize that portfolio, and it's really hard to do that because you don't know the energy usage of the homes that you're lending to, and so there are lots of companies trying to solve that problem. But if you can figure out a way to decarbonize your portfolio as a whole, you can then issue green bonds on that portfolio. So there's lots of exciting opportunities. So that's why I really like this intersection of climate and finance, because it really provides these win-win opportunities.
And now that you've built that practice, I remember in our conversation you talked about borrowing the urban stack definition that really expanded the way that you think about the built environment and how you need to plug in all of the pieces. What are the things that excite you, either in this space, because you have so much involvement in it, or generally that you are looking to make investments in the coming few years?
Yeah, I mean, I maybe just for your viewers, I'll explain the urban stack. So we kind of bucket our thesis into various sectors across which we call the urban stack. And so the urban stack represents the way cities are made up of interconnected layers, from the way you design them, build them, operate them, and experience them. And we look at companies across all of those layers that are innovating, generating impact, and have high potential for commercial returns. So when we think about climate fintech companies, it's generally at the kind of operate and experience layer. So you're either helping companies operate more efficiently, deploy climate solutions, or you're helping people experience the city and helping people deploy climate solutions in a more effective way. And so, lots of opportunities there that we see in that space. And what we tend to find is that, there's this wave of opportunity that's incredibly important, which is making cities more resilient. So thinking about not just decarbonizing cities, but actually if we accept the fact that climate change is coming, right, and it's impacting weather and climate, and it's causing problems for cities. We're seeing cities across the world that are too hot to live in, cities across the world that are seeing more climate disasters than ever before. Then we need to make cities more resilient towards those changes, and more adaptable towards those changes. And there are lots of opportunities to invest in technology companies that are solving some of those problems.
Totally agree. I don't know how, but we're almost up on time. It's really snuck up on us. So before I let you go, the thing I'd love to ask you, especially a lot of the people I'm sure who are listening to this episode may want to pitch you one day. What are the 3 things that founders can do to impress you?
That's a good question. I would actually turn that question around, I think, which is that there are not that many great companies out there and great founders. And luckily, there are some really great, passionate, fantastic business people and technology leaders. But there tend to be more VC funds chasing those great founders than the other way around, I would say. And so it's actually, I think, more appropriate for us to tell founders why they should choose us, rather than founders having to find a way to impress VCs. I think the best companies, they have their choice. They have their pick of the funds that are going to invest in them. They can curate their investment board, which is great. It's a fantastic thing to be able to do. And so I think, us as VCs, if I turn that question around, we need to really look at ourselves and think, how can we help this company? How can we add value beyond the capital? And that's actually, a question we ask ourselves every day with every investment that we do, every company that we look at. Can we add meaningful value to this business beyond just the capital that we put in? can we help to accelerate their commercial potential? Can we help breaking down some of the barriers and some of help them understand some of the regulatory challenges, for example? So that goes back to one of the reasons why we're quite focused investing in Europe and the US. And typically when we invest in the US, we invest in companies and founders that want to at some point expand to Europe, and we can help them understand how to expand into a pretty fragmented, a network of countries and opportunities that have very different regulatory challenges, and we can help them navigate that. And so, that's what I would say to founders that are looking for the best partner, that really look for someone who can provide some value beyond just the capital.
Amazing. And what a great humble way to end the conversation on. Totally agree. Some of the best founders in the space have, VCs on their waiting list, but most importantly, it's about those that can help. And I think the audience will definitely walk away with the understanding that you are passionate about the space, you know it really well, and as a fund, you're making sure you put your dollars to work. So I really appreciate you taking this time. Before we let you go, where can the audience find you?
Yeah, you can find me. So my email address is rahul@2150.vc. You can find me on LinkedIn. I'm on Twitter. You can find me in lots of places.
Amazing. Well, Rahul, thank you so much.
Great to see you. Thanks, Summer. Bye.